Welcome, everybody. This is the COVID-19 Impact on Commercial Real Estate Conference. My name is Adam Lipkin. I'm an executive director with Counterpoint and Armstrong. Really excited to be here today with a great group of panelists. We're going to jump right into it. And the theme of today's talk is really about what's lending, what product types, what's happening in the market. So we've got a great group. We have three very active national lenders, and we have a real top professional with CoStar, which is really the leading body when it comes to data to help make informed decisions. So we're going to take a format of having everybody introduce themselves, share a little bit more about yourself, your company, and the background, and then we'll dive right into what's been happening in the market, what had been happening before, and where you see things moving and what you want to be doing more of. So why don't we start off? We'll go with Daniela first. And Daniela, if you could introduce yourself, we'll start with you. We'll go to Doug, Paul, and Domenico, and we'll go on from there. Why don't you take a few minutes and introduce yourself?
Sure. So my name's Daniela. I work at Castellan Real Estate Partners, more specifically Castellan Capital, which is our bridge lending division. We are direct balance sheet lenders based in New York, but lending nationwide. Asset types, I think multifamily is definitely our bread and butter. We focus on quick close acquisition, value add, rehab, renovation, lease up. We are lending nationwide. I think, focus is primarily coastal markets, California, Florida, New York. But in the last 6 months to a year, we've spread out into other markets in the country. We've closed in Colorado, looking at Texas, Illinois, a lot of stuff in Ohio. Kind of a high level in our program.
Awesome. Thanks so much. Doug, what about yourself?
Sure. Thanks, Adam. Good morning. Doug Steves, Senior Loan Originator with Parkview Financial. Our corporate headquarters is located in Los Angeles, California. We have a satellite office in Denver, Atlanta, and in Denver, Atlanta, and Arizona. We are primarily ground-up construction lenders. We also do construction completion. We'd like to see deals from $10 million and up nationwide. We are a private capital lender. That's what we do.
Okay, great. Why don't I go to Domenico, if you could go next.
Sure. Thanks so much for having me on the on this panel. It's very excited about it. So I represent UC Funds. We're a direct private lender based out of Boston. We've got a few different offices around the country in Miami and Chicago. This is our 10-year anniversary. We've done about $2 billion in that 10-year interval. Just across the country, everything from adaptive reuse, all asset classes. Multifamily has been a focus, but we definitely do all the asset classes and look to execute and help create value for our entrepreneurs. I said adaptive reuse because we're seeing a lot of that, as well as, the ground up side of things, the simple turn of an asset that just may need some lipstick on it, if you will, and as well as other types of creative financing solutions that we can buy, whether it be debt or equity.
Awesome. Thanks, Tom. Paul, introduce yourself.
Hi, thank you, Adam. And my name is Paul Hendershot. I'm the Director of Analytics for CoStar. I primarily cover North Texas, Oklahoma, and Arkansas. If you're not familiar with CoStar, we are the world's leading provider of real estate data. We cover all the major food groups. And what really makes us unique is the fact that we do have someone like myself in every major market, pretty much providing that narrative to the data. We put together all the market, sub-market reports, provide presentations. So if you are looking at an asset, let's say in San Diego or Philadelphia or Dallas, Texas, you can call on me or someone on my team, and we can give you that unique boots on the ground perspective of what's going on in the market. And a little bit of myself, I've been with CoStar for about a year and a half now. Before joining CoStar, I was with a little boutique firm called JLL as their director of research for the Carolinas. And before getting into real estate, I dabbled in academia as a professor and also in economic development as well. That's where my career started.
You live in data. I love it. Awesome. Thanks, Paul. All right, let me just do a little bit of background as well, and I'd like to then have everybody talk a little bit about just your history in the commercial real estate financing world. But as I mentioned before, my name is Adam Lipkin. I'm going to be the moderator, play a little bit of a mini role as a panelist. I've been in commercial real estate financing since 2002 and had been on the capital advisory side since 2005, largely with national groups like HFF and others. And so I saw the last down cycle. I think a couple of us have gone through that. And it's very interesting for perspective to now be in another real challenging environment that has some similarities, but a lot of differences from the recession of 2008. And so I've been in this world now in 2017 of commercial PACE, which stands for Property Assessed Clean Energy. It's one of these alternative creative financing programs that's usually married with a senior lender. And it's really being done with construction specifically, although seeing lots of creative uses of it. So what I think would be interesting is I'd like to hear a little bit about your backgrounds in the commercial real estate financing field. Maybe we could start with, when you got started into it, kind of backing into now where you're at today with your group. But Danielle, why don't you just share a little bit about, what's been your background in commercial real estate financing?
Sure. So I started on the banking side, actually, at Torrey Pines Bank, which is a California division of Western Alliance Bank, and their commercial real estate department there. Yeah, I think, focusing there a little bit more on traditional real estate assets, not doing much outside of California, but I think their focus is really strong sponsors, but still some traditional assets, but mostly stabilized. From there, I went to BofI Federal Bank, which is now Axos Bank, working in their bridge lending, specialty lending group. I would say their majority of their properties were in California or New York at the time. Larger deal size, 25 million plus, all transitional properties, a lot of construction with the team there. And then about 3 years ago, I moved to work for Castellon on the private side, private bridge debt. And here we focus nationwide, but I would say, our deal size is 1 to 40 million.
Okay, great. Thanks for that background. So you've been in the real estate finance field. You've seen a few different perspectives from the banking side to now in this specialty finance group. That's great. Great perspective. Mm-hmm. Really great to have you on the panel. Good. Doug, a little bit about yourself too before you joined Parkview. How many years there? It would be great to hear a little bit about your history.
Sure. Thank you. About 25 years total in the commercial real estate, land development, and private capital financing business. Started in commercial real estate, quickly moved towards land acquisition and development. I did that for quite some time. In about 94, I moved towards private capital funding. Been there 25 years, director of real estate finance for publicly held Bridge Financial, a subsidiary of Arizona and New Mexico Land Company. Then with USA Capital for a number of years till they folded in 2007. And now with Parkview, doing a lot less land than I've ever done. That's always been my specialization. And again, with a national platform lender, doing mostly ground up construction. I'm a licensed California real estate broker, a licensed mortgage broker, and a licensed appraiser in California as well.
Awesome. And how many years with Parkview?
This is my first year at Parkview.
Okay, great. A wealth of knowledge and wealth of experience. Really interesting to see both that principal side as well as the lender side. Probably really adds a ton of value to the client. So awesome. Thanks for being on the panel with us today.
Thank you.
Domenico? Yeah, my pleasure. Domenico, a little bit about the background. I know with UC for a little bit, but tell us a little bit about your history.
Right. Thanks, Adam. So I've been with UC Funds about 8 years now. Been in sales for about 20 plus years, had my own company in healthcare before that, and did some sales within healthcare as well. And then Dan Palmer, good friend of mine, CEO of the company, asked about what I thought about working with UC Funds, and I haven't looked back since. It's been a great opportunity here, and pretty much been working. Started out in originations, and now I have the privilege of heading up his originations team at UC Funds, and trying to provide capital nationwide, and is what we do every day.
That's excellent. Great. Stay with the group for a while with Dan and the team. That's awesome. Thank you. Paul, I know you shared a little bit about the academia background, and then, but maybe get us a little into, I know JLL, just a little bit of history too. You could get into it.
Yeah, just to kind of go back, I was that guy who didn't really know what they were supposed to do in college after the Air Force. And so I ended up taking that principles of macroeconomics and fell in love with it. And I've been in research in one capacity or another ever since. Like I said, starting out in economic development, working for several chambers and economic development groups. And I really love that the creation of space and the role real estate plays in just like how we're defining our society, for lack of a better way to describe it. And then moved on, had a consulting firm in San Diego for a few years, where I had the privilege to define the life science industry of Southern California, worked with Biocom, and also headed up a clean tech initiative. You mentioned some of that kind of, that type of industry. And really got into like how lab space is being developed, where we should locate it, in terms of location quotients, the workforce development side, and then I ended up in Charlotte, North Carolina, and a colleague of mine in economic development started work with JLL, and he basically, said, "We have a position, or would you be interested?" And that's really where I had an opportunity to dive into the nuts and bolts of the real estate deal, seeing it from that brokerage side. And I had an opportunity to work on, several large projects in a very high growth market, some of the largest construction projects, leases. We created pretty much the industry of redefining fintech and that convergence of technology and banking, and what that means to real estate. And we were seeing these green shoots before they were even recognized. And with CoStar, what I really love about this position is it allows me to get back to that true real estate research position. I'm able to allow the data to tell the story, right, wrong, or indifferent. We serve as that even-handed broker, if you will, in terms of the data. And so now it's like grad school has never ended. I pretty much just read, write, and research, much to my dismay sometimes. So, but that's a little bit about my background and how I've worked in commercial real estate.
Awesome. No, really, we're going to get into that a little bit and talk a little bit about how you're interpreting the data you're seeing today. So great to have that wealth of knowledge and that background. So let's talk a little bit about, we've all had experiences at our current groups. We saw what it was like pre-COVID. Let's talk a little bit about what the most recent year looked like in terms of volume and the kind of projects that you were working on and funding in 2019. And then I'd like to fast forward to first quarter of this year, and then what we just saw in the second quarter. So Danielle, I think it's interesting to talk a little bit about recent history because it informs, to an extent, what you've been doing. Not to say we don't obviously change in dynamic situations, create different, different opportunities. But let's share a little bit about what you had just been doing in 2019 in terms of volume. What were some projects that you had done a handful of? If there was one that you did maybe as a profile, handful of handful of some asset type. And then maybe give us a little bit of a perspective on first quarter and then what we now just saw in the last quarter. And I'll start out with you, Danielle, if you could take that.
Sure. So, 2019 was, I would say, a very strong year for our firm. We closed upwards of $250 million spread across, I would say, about 35 different loans. Some of the highlight deals that we did two large co-op deals in New York. Co-ops are a little bit of a trickier asset type, which tend to sometimes fall in the bridge private lending space because not all banks will lend against it. They don't understand the structure as far as the stock certificates versus a traditional mortgage. So we did close two large deals. One was 28 million, another was 20 million, in both in New York, that structure type. We did do a handful of hotel deals in 2019 as well. We closed 3 hotel deals, which thankfully are all still performing as of today. So that's also good news. And I think, we started 2020 optimistic. And I would say January, February, we closed $25 to $30 million in loans, expected to kind of continue that pace throughout the year. And then end of February, March hit, and it felt like the sky was falling a little bit, of course.
Sure.
I think that everybody kind of took a bit of a pause. March and April were very slow for us, being candid. I think I tend to doubt anybody that says otherwise at that time period. I think the deal flow dried up. Lenders, I think, wanted to take a step back and see how their existing portfolio was going to perform, what their capital resources were going to look like in 1 month, 2 months, 3 months. We did close one deal in that March, April timeframe, but that was kind of an existing pre-COVID one that was already under term sheet.
Yep.
And then I would say now, May, June, July, we've definitely seen the deal flow pick up a lot more. I think that exactly what happened is I think borrowers that didn't really consider themselves to be bridge borrowers before, now in the time of COVID, are realizing that maybe they will be. So we're seeing a lot of quick close acquisition deals where CMBS, traditional lenders, pulled out last minute. And, actually we just closed, a couple weeks ago, a retail deal in Las Vegas. CMBS lender backed out. There was a TOE closing, and so we came in. Probably would not have been a bridge deal otherwise, but that's kind of our specialty.
Awesome. We'll talk more about that project. We'll come back around, but I want to hear more about some of the highlights. But I appreciate that perspective. It's very interesting. Gives a sense of like where we're at. Doug, if you could share a little about the same thing. I know you said you came on last year. What was Parkview doing as a company in 2019 in terms of volume, in terms of number of transactions, where you felt there was a concentration, and maybe fast forward to this first quarter and second quarter, what you're seeing today? Appreciate it.
Sure. In 2018, we decided to be a national lender and really started working our way across the nation. 2019, we did approximately $400 million across 22 deals. First quarter 2020, we did $120 million. Second quarter, we closed 0. And so, we're back now with a strong pipeline. We're probably positioned to close third quarter $100 million with any unforeseen catastrophes in the economy or in the market or this virus. Being based in California, we've been subjected to all the potential issues that you could be subjected to, close downs.
Unbelievable. Sure.
Mm-hmm. Yeah, we finally went back to the office this Monday on a sporadic basis where you could kind of pick and choose whether you wanted to be in or out of the office. So that's a real good sign. We were waiting to see some velocity in the markets, velocity of capital, not necessarily trades, but capital. Who's getting paid off? Are there bridge lenders that are doing deals? Are we getting repaid on some of our loans? That's what caused us to call a timeout in really April and May. We started getting payoffs May and June, started to see the loosening up of some capital, some more transactions. That gave us more confidence to get back and start underwriting again, start assessing new transactions. We were never in hotel hospitality. We were never in assisted living, senior care facilities. So those two asset classes have not changed for us. We were never strong in retail either. So where we're probably something that we've left for now that we may not go back to is as much bridge lending as we were doing. We were bridge lending on the land to get to the permits. So that's kind of where we're at, but it seems to be light at the end of the tunnel for us right now. And we're all back to work. We're all back to the office and as we can in California.
Awesome. Just one quick follow-up question. Tremendous volume in 2019. That concentration was more multifamily, or where did you find that concentration?
Yeah, it was mostly multifamily. We did some student housing. We found a little niche in doing some multifamily that was more. We did some micro units. We did some co-living projects. Seattle, California, New York, some of the highly populated areas. High cost of living areas, San Diego as well. So that's a little niche that we've been playing with. Did a couple student housing projects, one with PACE financing. That's still going well. So, but I'd say the highest concentration, yes, is multifamily. Looking to do more industrial right now. especially with the proliferation of distribution and the Amazons of the world and all the businesses and companies that Amazon spawns around their major distribution facilities. So we'd really like to, across the nation, get more involved in big box industrial distribution.
Okay, great. No, appreciate that color. Dom, a little bit about where UC was in 2019, first quarter this year, what's happening in second quarter. Give us a little bit of perspective.
Sure. So
in
2019, yeah, right. Doesn't everybody have one, right? So in 2019, we did about 30 transactions, totaling about $350 million nationwide, all the asset classes. I think we touched on every one at least, in that year. The bulwark of it was multi, but we definitely did our share of hotels and in retail and office and industrial, and as well as land. So we'll look at anything, and really don't say no to much as far as taking a look at the deal at least, and then going from there. If the deal makes sense, we'll make a run at it. So we're very fortunate to have done that volume in 2019. Kicking off 2020, very steady deal flow, did about, I'd say about 50, 60 million, and then in Q2, it was an interesting situation, right? Adam, you and I closed the deal, right at the peak of it in March. Adam Company and UC Funds, we worked together to do a ground up deal in Koreatown, LA. Tremendous opportunity, tremendous sponsor, great asset. We worked with Pace, and we closed that right at the height of the COVID situation taking off. And then that was a $30 million deal. And then from there, we just kept running. And we've not pulled back at all. In fact, we've gone the other way. And so from March till now, we've closed about another $200 million in deals, and we have about $600 million in the pipeline to close.
My goodness.
Yeah. Wow. And so we are not, you mentioned about the data, about the dips and all that. And I go back to a great economist, Alan Greenspan. Okay. And he took, and being an Air Force guy, you'll appreciate this. He flew with Reagan across the country. When Reagan took office, and Greenspan had a pile of books, and he was sitting down in Air Force One. He's like, let's go through all this stuff and let's talk about it. And he's talking about just what he expects in the economy. And Reagan goes, just put it all away, Alan. And he goes, Alan, I just want to tell you one thing. Markets go up and they come down, and then they go up again, And Greenspan went on to say that was the best conversation he had in his entirety of his career as being an economist, And it was pretty interesting because I give a lot of credit to Dan, the CEO. He really, we rallied when this thing all went crazy, and it went crazy in Boston first, or one of the two first places. It was, all right, so what are we doing? And he just said, you know what? We're just going to keep going. We're going to actually turn this around. And we reached out. Everybody joined the sales team at that point, and made a bunch of calls. The head of marketing, Rosemary Console, did a great job in marshaling that and getting it going, and working with Dan and just really pushing that forward. And from that, we've been able to really develop a tremendous pipeline. So we see a lot of opportunity moving forward. And the bulk of that $600 million is ground up multi and other facets of multi that are in different phases of profitability.
No, just to piggyback on your point. I mean, I think, we all were blessed with the last decade. We were pretty much beating every record in terms of sales volume year over year, pretty much since 2010. Just to put it in perspective, in 2010, national sales volume was just about $30 billion. And in 2019, which was the highest point of the decade, which was the peak, it hit $164 billion. 2018, which was the second highest, was $148 billion. I mean, so the deal volume, there was lots of dry powder, lots of growth. I mean, we were, it was just a great decade, for lack of a better way to describe it. I mean, we're even from a a macro and micro perspective, we're starting to see wages push, allowing landlords to push rents a little higher. And then you had the high flying, markets, I call that, the Phoenixes, the Charlottes, where like Charlotte, for example, is adding they're still adding 40,000 people a year. Dallas-Fort Worth is adding over 100,000 people a year. A lot of those are millennials who are looking for that first job, their first place to live. I mean, the number of units we've added has been unprecedented. But when this pandemic hit, it has, to quote Mike Tyson, we all had a plan going into 2020. So, everyone has a plan until they get punched in the face. And that pandemic was basically that Mike Tyson uppercut that hit us. And just looking at the deal volume, there are deals getting done, and that is a positive. But it has dropped off significantly. In the first quarter, we saw about 30 million in deals. So just to kind of think of that, we sold in the first quarter of 2020, the same number of the amount of volume we had the entire year of 2010. And then in the second quarter, it's fallen off to about $10 billion. So we had a drop of about 65%. Now, that's not to say that, like I said, deals are still getting done. We've sold over, in the second quarter, over 92,000 units. Over 2,300 transactions have taken place. So even with all the uncertainty, with everything going on, I would say this speaks volumes to the resiliency of the real estate market, the resiliency of the you could say the multifamily market in particular, and quite frankly, the old adage, one of my professors said back in the day, demographics is destiny. So if you look for those high growth markets with high wage growth, you pretty much still can't miss even today.
Adam, if you don't mind, let me piggyback off of Paul's response. And we have had a slow second quarter. We didn't close anything, but we have plenty of capital. We are entertaining new deals. We are filling back up our pipeline, much to the confidences that Domenico had mentioned. We were not that zealous, but we were still confident, still moving forward. So to the audience out there, we're looking for new business. We're looking for deals. As I think most capital providers are in the market, we're real cautious, and we're doing more deep dive data extraction and using data as we can. But I think I'm pretty safe in saying all of the capital providers in the market have capital and looking to deploy it.
Yeah, absolutely. Let's talk about that, because I think we all saw the last cycle, and look, sometimes you get lucky in a crisis and sometimes you don't. I was definitely a deer in headlights last cycle. I was doing mostly condo development and condo conversion financing, and saw that go from this to off a cliff. Crazy. So, you just never know where you end up. And frankly, if you were niched into hotel financing in this cycle, you'd be in a tough spot. Dom, I'm going to borrow your line. I'm sorry to steal it from you, but I heard your CEO say that this is your Super Bowl. And I feel like everybody on the panel here is in that space where there's so much of a need, I think more than ever, for non-bank financing that's able to do things in a time where the banks are going to be getting more conservative. I think Doug, I think Danielle, I think Dom, you have this incredible opportunity right now to be able to capture incredible deal flow that maybe you weren't seeing that same type of deal flow before from the same groups. And so have you noticed right now that there's more and more of a range of borrowers and projects? Tell me a little bit about what you've seen in terms of just incoming deal flow. I'd love to hear about that. Danielle, if you want to start us off, and I'd like to just kind of get into that, what you're seeing in terms of just requests, and then we'll talk about what's actually, be able to get done. But I'd love to hear more about that.
Yeah, sure. And I agree exactly with what Doug said. For us, thankfully, our portfolio has performed extremely well. So the issue is not capital. We have the money. We're looking to put it out. It's just looking for quality deal flow. And I think that what I've noticed from borrowers in the past couple months is what's become more important to them over proceeds, over rate, is just certainty of execution. I think that so many borrowers have been retraded, lenders have fallen out, And so having a lender that they know is going to get them to the finish line and is going to be there is what really adds value to the deal. And I think, groups like ours, where we have all discretion and capital, there's no outside investment committee, where we know that here's our term sheet, we're going to close on these terms. I think that that's exactly what borrowers are looking for right now. And I'm seeing that across all different asset types and all different types of borrowing groups, the small developer or the more institutional. I think that everybody's just looking for someone that they know will be there for them on closing date. And I think that unfortunately, some of the CMBS, the life insurance groups, banks just can't offer that right now.
Right. Absolutely. What does get done with your group right now today?
I think our asset types have remained, pretty much the same as they were before. We're doing some condo inventory deals. We're seeing a lot of multifamily acquisition requests. Like I said, we are pretty fluid with our capital, so we can close deals in as quick as a week if they need to be. So we're doing a lot of multifamily acquisition, lease up. We're just about to close on a deal in Salt Lake City, which is a recently renovated multifamily property. It's 100% vacant. So it's just a lease up play, and then they'll perm it out. We've done some retail acquisition deals. I think at lower leverage than maybe we were pre-COVID, sub 60% of cost typically on retail right now. But we'll get it done. We typically have no prepay, no minimum interest. So I think that what gets done is deals that they know they need someone to close and then have flexibility to perm out once those traditional lenders are ready and available.
Yeah. Got it. Good to know. Just one last thing. I'm going to go around to everybody just to understand a little bit more parameters. Let's use that multifamily scenario. You said it's completely vacant. Let's call it max loan to cost, loan to value underwriting constraint on a empty multifamily recently completed. How would you look at that? Where do you max out? I know it's not the same on every deal, but where do you think right now you would go up to?
Yeah, I think, most likely we're going to be around the 60% range. I think max maybe 65. But I've also seen, in this instance, the borrower is not looking for max proceeds. They're just looking for something to kind of tide them over. We are more apt at this point to do lower leverage, lower pricing. I think that, I think just given the uncertainty in the market, we'll do lower proceeds, lower rate any day. So that's kind of what this deal is. It's a sub 60% leverage deal, but our pricing is on the lower end, even pre-COVID pricing. So.
And sorry, just last thing, and then lower end pricing is like 6%. Like what kind of range do you think lower pricing looks like?
Yeah. High sixes, 6.95. That's kind of our floor on our pricing.
Got it. So like 7. Go ahead, Paul.
Yeah, one aspect of the fundamentals we haven't mentioned yet in terms of, we've mentioned the volume and how these deals are getting across the finish line. And these, and I think that's basically the nuts and bolts of what we need to get to. But the fact that the pricing per unit is held up, I mean, it's held pretty much steady through the first and second quarter. We're at about $200,000 a door nationally. And we haven't seen the bottom falling out. Actually, particularly in markets with a high concentration of 1970s and 80s vintage properties like Dallas-Fort Worth, we have over nearly 50% of the inventory was built during that era. We're still seeing a lot of value investors coming in, particularly in the mid-cities area. Is a great kind of suburban play. We're seeing still a lot of activity there where there's still lower barriers to entry, or wealthy individuals can still get their foot in the door. So there is, that the fact that pricing has held up. I mean, we have not seen the bottom fall out yet. I think is key to this as well.
Yeah. Well, Paul, to your point, that's interesting because we haven't seen cap rates really adjust much yet. Exactly. Because those trades are still at market, there's still trades going on, and so we're not having a big problem with valuation yet. Some appraisal issues we've had on valuation is not underwriting any rent growth and bumping the vacancy rates and expenses up a little bit, but the cap rates have stayed pretty close to expectations.
And even
Doug, let's talk a little bit about what you're looking at today and what you're focused on. What are you seeing happening right now?
I'm sorry.
In terms of either deals that you've signed up? Yeah, what I was saying is what in terms of what you're looking at right now today, what are deals that you're signing up or that you have signed up, and what do you want to do more of? And then let's talk a little bit about max leverage, minimum pricing, some of those metrics.
Sure. We're getting a lot of construction completion requests. Banks, more institutional level lenders just called a timeout and stopped funding draws, or they were up to the finish line in February, maybe early March, and just called a timeout and said, we're not funding the deal. And so probably more than ever, we're seeing construction completion loans. And we're seeing sponsors that come from the banks because the banks literally just said no. And instead of waiting to see if the banks are going to reemerge, they just want to do the deal now. Like Danielle, our leverage has gone down from 65 loan to value to 60. We can push deals to 75% loan to cost, but you better figure that's for core asset, core location with strong sponsorship. We're priced between banks and money. We're going to be somewhere in the 9% range. We like to do 24-month terms, no prepayment. One of our competitive advantages is we'll do non-recourse. So we're not FICO score driven. We're not tax return driven. We'll do clients that have had bankruptcies. So that is a competitive advantage for us. In addition, we allow mezzanine financing, not to be recorded against the property, but we'll allow mezzanine financing. We'll allow EB5 equity, and we do deals with PACE financing as well.
Awesome. Let me just dive a little bit. Go ahead. What was that?
I was going to say, and that's usually not for everybody. Those unique deal structures utilizing EB5, PACE, mezz, and senior.
Yeah, we'll get into that in a second. Let me just come back because I just wanted to hear one point on the construction completion. Give me a little bit of a metric on where you'll go max on a loan to cost on a construction completion multifamily project. So somebody's building the apartment. To your point, bank stop funding. Where would you go up to based on a loan to cost, loan to value?
Yeah, again, project specific, location specific, state specific, but generally speaking, we're going to be at 65% loan to value, maximum 75% loan to cost, which is causing a disconnect because a lot of the banks underwrote to close to those ratios. So now we've got to come in, add in interest reserve, reestablish interest reserve, pay points, pay fees, pay closing, and pay payables. And so more often than not, every time we analyze a construction completion deal, there's a new call for equity.
Sounds like you need some pace instead of equity, but we'll come back to that. Dom, tell me a little bit about what's...
If you know somebody, let me know.
Yeah. So Dom, I think that that would be good to dovetail into some of what you're doing in the last two quarters, just to share background. We had a nice transaction that you had mentioned, the ground up multi. We did about $14.5 million of PACE. You did $30 million of senior. I think we got to 80% combined leverage between us at 25% of the capital, you at 55. It sounds like that's a good sweet spot for ground up multi. But tell me a little bit, same metrics as we just asked with Doug and Daniela. What are you wanting to do more of now, and where could you get to in terms of max leverage on a loan to cost, loan to value? And where's kind of like the general rate range? Where's the minimum? Be great to hear more about that.
Sure. So as far as more of now, I'd say more of the same, which is all asset classes is what we're looking at, right? We're not saying no to anything. We're gonna evaluate everyone on its individual merits and location, right? What we're seeing a lot of is because we are doing adaptive reuse and ground up and those types of deals. There was a lot of collateral damage, if you will, that fell out of just everything stopping on the capital market side. In those deals, we're looking for a home, and that's why we've closed so much in Q2, or in Q2. That's why we closed so much, is we really took a lot of deals that were ready to close and had historic tax credits, had PACE, had mezzanine loans, had, everything under the sun as far as commercial real estate finance in the capital stack. And, pretty sophisticated as far as being able to manage those things and take care of them on the legal side, and got them to fruition, thankfully. And so, as far as, those types of deals, and we can handle more of that. We're really open to anything as far as, the deals that come across my desk from my team and stuff. It's not, we just look at them individually and say, all right, does it have merit? As one would look at any deal, and then move forward. We really value, what the entrepreneur is trying to do and create value in this market. And sometimes, it's the deal that fell out of the CMBS world, right? And we closed a $33 million multi deal, and I'm smiling because there's no way I would have seen this deal a year ago. Okay, like there's no way. And and the thing was cash flowing at a 1.2 DSCR, and they needed execution. And to your point about the certainty of execution, so we're seeing the full breadth of what the market has to provide, and we're okay with that. We'll keep swinging. We love doing, the pace, the historic tax. So as far as leverage goes, we're going to get up to 75% loan to cost on a deal. That's the mark we try and hit for people. We feel that really creates value for people on the transactions. Obviously, every deal has its own, specifics that need to be evaluated to see if we can get there. We've had a lot of success, like Adam was saying, with pace in climbing the stack even higher and getting to like 82% on a ground up deal. And so it's pretty interesting environment, as far as from where I sit, from where it was a year ago to where it is today. It's very exciting. We like it a lot, and we're just going to keep the pedal to the metal and keep pushing.
Good. So, Paul, I'm sorry. Go ahead. You wanted to say something?
We just kind of want to, tie in a few points as far as the multifamily construction. I mean, the big, every presentation I did before January, everyone asked me about overheated over construction. Now, no one seems to be talking about that. Yeah. I mean, the fact of the matter is that we have the largest construction pipeline of multifamily units in the history of America, at over 600,000 units underway today. And now, up until this point, we've been doing a great job of absorbing all these units. Vacancy rates have remained stable, even in those high-flying, like a Charlotte, where they added 20% of their inventory in the last 5 years, and all these stories we've managed to keep up. But we are starting to see a few cracks in that market, like particularly in Los Angeles. For the first time in the last 12 months, we've seen negative net absorption in the multifamily. Maybe some folks are beginning to couple up. They're holding back, moving in with their parents. That's maybe a possibility. But, the fact of the matter is that, we have to, consider when we're looking at these markets or these, sub-markets, is that construction pipeline. And what's really one of the most interesting points in the last few years, and particularly, the tail end of this cycle, everyone wrote off the suburbs going into this. Remember, all the millennials were going to live in downtown. They're going to work next to their office. They're going to ride fixie bikes, drink craft beer, never get married. And we're all going to be this great urban renewal experiment. Well, the exact opposite had happened. All those millennials, maybe they can't afford to buy a home, but they're looking to move to those suburbs, and they're looking to move into nice mid-rise places. And so as as much of a rabble rousers as they wanted to be and say, we'll never go to the burbs, guess what? The baby boomers went to the burbs. The millennials went to the burbs. So they're next. And just looking at Dallas as an example of kind of that high growth market, over 2/3 of our construction right now is considered in suburban markets. So I think that's an area that's been overlooked. And I think there's still growth in the suburbs as well. And another point, as far as
that was a big number.
Yeah.
Hey, Paul, you said 600,000 units in the pipeline, right? 600,000 was the number. Unbelievable. Yeah. How much is there that hasn't started yet, but just sitting there shovel ready, waiting to be built? Do you have that down at all? I'm curious what that number is.
Well, we CoStar here at CoStar, we don't count something under construction until cement is poured. That's kind of our baseline, because we found it a bit problematic when you look at proposed deals, like, as we're all, an investment in construction developers. There's some developers a little bit more optimistic than others in terms of the proposed deal to when it actually will break ground. So we just use a baseline. But in terms of the proposed projects, there's still, just anecdotally looking at the data, there's still quite a bit of stuff in the pipeline. Permits are still getting pushed through, and that's another indicator I look at. But it is, that's a huge pipeline. Also, in terms of what Doug said earlier about the EB5 and foreign capital, we're seeing more foreign capital flooding all asset types, particularly industrial and multifamily, than ever. Some of the largest transactions this last year were Korean buyers. And I think as the uncertainty around the globe continues to permeate, the United States, for all of, you could debate our economy and if, how sustainable it is all day long, I suppose. End of the day, we're still the cleanest shirt in the dirty clothes hamper. And we'll see foreign capital find its way to the United States, particularly through EB5 funding and other means.
Got it. All right, so I'm going to cut to the chase because I'm going to put my broker hat on. I've been one most of my life, and I felt like there were three things that we wanted to know more than anything from lenders. What's the most money you could get? What's the cheapest rate you could get? And who could deliver most execution with structure, right? So it used to be back in the day, pick two, right? You're either going to get the highest leverage and maybe a higher rate, not the lower rate. Maybe you're going to execute better. So usually somebody does two of those three really well. But in this environment, what I find absolutely incredible what's happening is that the non-banks are getting an enormous amount of projects, unbelievable amount. I'm going to focus in on the multifamily sector because I think that's where there's just so much that I'm seeing for sure. But to give you a little bit of perspective, I got into this PACE world about 3 years ago. Now, a lot of people want to use PACE for replacing equity, but a lot of folks see it as stretching senior leverage. It's in this tax assessment position. So there's kind of pros and cons to it. And so what I found is the success has been with non-banks that are usually looking at PACE at some kind of a combined loan to cost and combined loan to value and saying, what's a comfortable combined basis? Now, what I had seen up until recently was that combined leverage on a multifamily maybe was maxing out in the low 80s. Let's call it 80 to 85% loan to cost. Maybe I come in with PACE for 20%. Maybe a senior lender does 60 to 65. The challenge was to date is that the non-bank rate was somewhere between 8 to 10% for that. The PACE rate is kind of like in a sub 6%. If you blend it, you're probably taking off 100 basis points. Maybe you're looking in the mid sevens for a blended rate. And frankly, that just wasn't as competitive as what was available, which was going to a major bank, the OZKs of the world, the Centennials of the world, all these other ones that were doing 65% leverage or 60% leverage non-recourse, and then coupling that up with any number of mezzanine or preferred equity groups to get to that same leverage. That does not exist today. I do not know of many mezz preferred lenders that are doing anything. They're in even a tougher position than a lot of seniors because they were in that first loss position. And so I find that to get to high leverage, non-recourse financing, you pretty much have to go to a non-bank. And so a lot of folks have been trying to mix PACE in at some level to replace out dollars or get to a higher combined leverage. I'd like to focus on, for the folks that are in the audience and listening and saying, we are interested in maxing out leverage, we want to know how high we could get. Let's focus on multifamily for a second, because I do think that's probably the most, let's call it liquid transaction area in terms of asset classes. Where do you think you could get today? And Danielle, I'll start with you. I don't think construction, you're not doing construction, but let's focus on that takeout scenario for a recently completed multifamily project. Somebody has that completion event. They want to take out the construction lender. There's no interest reserve. They're looking at you to come in and recapitalize them, and they're just trying to get as much money as they possibly can. What's the max leverage that you could get to? And I don't know if you've done a PACE transaction yet, but it would be something to think about. What's the highest combined loan to cost that you think the group would consider if everything lined up? 70, 75% combined. And then I'd like to ask Doug and Dom, we could get into those kind of specifics.
Yeah, sure. And yeah, as far as capital stacks go, I think those are exactly the three kind of groups: EB5, PACE, MEZ. EB5 is not new for us. We did 3 EB5 deals last year. 2 were hotels, 1 was condo inventory, but I don't see as much EB5 activity in the multifamily space. Maybe that's coming, but I haven't seen it yet. The PACE financing, we haven't done a deal with PACE because exactly like you said, I think a lot of those at this point are ground up construction projects, which we're not financing. We do construction completion. So if there was a PACE deal with a construction completion component, maybe we would look at it. I think max leverage that we're getting to these days is by bringing in MEZ lenders. We actually do have a handful of groups that are still active, that we've closed with before and that are still working with us. Typically how that cap stack looks like is we're at 60, 65% of leverage, and our bottom, our cheapest pricing at the high 6, 7, and 1. And then the MEZ lender comes in and they can get to typically 75%. Maybe there's a few that are still pushing to 80, but I would say 75 is really kind of that cap. And, for the blended rate at that point, usually we can do something around 9 and 2.
Got it.
And that's kind of like our best mixed cap. Yep.
Excellent. Thank you. And Doug, what about yourself? I know you're looking at both construction and construction completion. Let's take that same multifamily scenario. What could you do on a ground up multifamily today with your leverage? And then what do you think you could do combined with PACE? And then also on a completion scenario, you're trying to finish a project mid-construction. I know you mentioned one of those, and then maybe even post-CO. Where do you think you could get to for max leverage with Parkview, max combined? Obviously, deals have to line up. It has to be the right market, project, sponsor. But what do you think you can max out at?
Well, we're still in a very cautious position right now. So we're going to be down in that 60, 65% loan to value, 75% max. Even with PACE financing, we will take a look at deals in excess of 75% loan to cost, but we start getting a little nervous, and it's really got to be a special project. Paul Raheem, the CEO, and myself and some others have been through a couple of these cycles, and we've learned one thing for sure: debt can really not be your friend, high leverage. So we're cautioning, our internal people, we're cautioning our brokers and sponsors and borrowers that be careful going out to market looking for high leverage. In these uncertain times, in these kind of risky times, these uncertain economic, where we're at in the cycle, where we're at with this election, we know you want leverage, we get it. We know you might need leverage, we get it. But make no mistake about it, if there's anything that'll take a project down sooner than later, it's high leverage. So to that end, we've dropped our leverage back a little bit. We're getting paid for the risk now. Our rates have actually gone up a little, probably 150 basis points. We want to be paid for the risk, and we want to be paid for the uncertainty that's currently in the marketplace. So, we may be a little contrary to what Dominique's group is doing. We're still deploying capital, but, we've got to really protect our fund and think about the long term, not just transaction by transaction.
Yeah, totally get it. So just kind of at a high level, just so I have some data points, would you say 70% combined with PACE for a ground up multifamily? Like maybe like 55, 60 on the senior, maybe getting to 70 combined? Is that maybe the max?
We're comfortable at 75, but we will consider and look, and we've done up to 80, but 75 is our real comfort level.
On a loan to cost? Loan to
Yes.
cost, 75? Okay, gotcha.
Yes.
And then let's just kind of then do, so we're seeing a lot of these recap needs. A lot of folks, to your point earlier, they got started with construction, they had overruns, they had delays. I think we're all seeing a lot of that. And they're either mid-construction or they're post-construction. They need to be recapitalized. They're looking at how to take out their existing capital structure, whether it be a senior and MEZ together. Let's dive into that. The only reason I'm saying that because I'm just even an overwhelming amount of that. All of us would be happy to do that, especially for multifamily. And so it'd be good to know a little bit more details on what that could look like if you have everything checked the box. So Doug, same scenario, let's say you had a project mid-construction, somebody needs to get as much as they can to get out of their current debt and current capital. is that maxing out at 60% of the cost of the project? Is that going higher? Where do you think that pencils out?
Yeah, well, let me back up just a little bit. Our big concern is why is there a construction completion issue? Is it execution problem? Is it budget overruns? Or is it literally the bank just stopped mid-transaction and said, hey, to no fault of the sponsor or the borrower? So once we kind of get a grip on that, then we assess the numbers, we assess moving forward, then we look at our leverage points. But let's just say for a minute, it simply was Bank of ABC stopped financing halfway through the project. We'll come in and we'll do 75% loan to cost. We'll do 65% of stabilized value. We'll probably want to replenish the interest reserve, charge some points and fees. But two things that become very important in that situation. One is we really have to get with our internal construction group and analyze and reconcile what's been spent, what's still to do, where we're at. That's a real Rubik's Cube, if you will. Secondly, when you have a broken priority now, in these uncertain economic times, title insurance is really hard to get. We go through a whole indemnification process and have to get special endorsements because you can have liens lingering out there. Not every title company will come along and insure title there. So that's a 2 to 3 week process that you kind of have to figure into the timeline. Won't really affect the economics of the deal, but it will affect the timelines. And there are some instances where the borrower is not strong enough, or maybe not strong enough at that time, where the title company says, this one's not for us. We've been underwritten as a lender and those indemnification packages, so we're comfortable, but that's a big issue. So things to think about. All that being said, we don't price and we don't lever much different in a construction completion scenario than we do a ground up construction scenario.
The pricing is 9-10%. Is it in that range?
Right now, we're going to be about 9%. Yeah, 8 3/4 to 9.5%.
Got it. That's 2 points. Then you said,
yeah, 2 points for a 24-month deal.
You'll come up with the last dollar amount of a loan, like a 65%, and then you'll basically say, that's our last dollar. We'll replace those dollars with PACE, but we're not going to go higher. That's the idea?
Correct.
Okay, got it. All right. No, I'd like to get that detail because a lot of questions come in just like that. So it's good for people to just get a sense of how do you look at the capital stack. That's usually where everybody jumps into. They say, yeah, we're gonna have everything else work out. You're gonna love our sponsor. You're gonna love our project. Maybe, maybe not. But they want to know ultimately like where you get to in terms of leverage and all that. So I appreciate you giving us a little color. Paul, go for it.
Sure. Yeah, I had a question for Doug. You mentioned some of the possible headwinds in terms of construction, and and we've heard obviously construction costs have been rising. And have you seen any problems as far as the labor issues on any of your projects? Has that been something that's still that's still a thing? I know it was 6 months ago.
We haven't, as expected, we haven't seen too much, especially in California. We have a lot of projects in California, and with the COVID virus here, in many instances, they've seen construction, even residential construction, as what's the right term? Necessary. What's the right term I'm looking
Essential
for?
business.
Essential businesses. Yeah. And so we've been able to keep crews. Now, the interesting thing is most of our sophisticated sponsors have gone back to the market, sharpened their pencil, and told their GC, hey, we're retooling our costs here. And so although there might be increase in cost of capital, we're seeing a decrease in cost of construction costs pretty much nationwide now. And there does seem to be plenty of labor right now and plenty of materials because so many projects have been put on ice, Paul, that we've now have an abundance of material and labor at better prices.
Absolutely.
Someone's winning again.
Essential is the distinction we look for.
Small win.
Dom, I want to turn to you for a second. We're obviously there's just an unbelievable amount of inventory. There's a lot of folks that have shovel-ready projects. They've now had to regroup. Their previous capital solutions aren't now as available, and now they're coming to new solutions. So let's talk about ground up multifamily today, and let's talk about the recap scenario that we went through, what that would look like on a new multifamily presented to you. What kind of max loan to cost, max loan to value would you look at with and without PACE? And maybe we could talk about some live deals. I know we did that ground up multi, so I like that as an example. I know we're looking at a recap, so tell me a little bit about internally how your group is sizing a construction completion scenario mid-construction, and let's put in the details.
Great. So looking at the recap scenario, right? So just on a global sense about the, where we are and where we're going to be. I as a firm, we believe America's best days are ahead of us. Okay. We don't feel like this is, even though there's 600,000 units in the pipeline of ground up construction, I'm not looking around Boston seeing empty multifamilies. You know what I mean? Like they're getting absorbed in LA. We feel like we closed that deal in LA. In Koreatown, there's a huge demand there. From what I'm hearing internally from the borrowers, there's such a pent up need for multi in that market. It's hard to imagine that there was negative absorption. You know what I mean? And but it is what it is. I think the aspect of these deals, other people have stopped lending on. Right? We're going to get to 75% loan to cost. Most of the time that borrower has had significant amount of equity in the deal already. Right. So maybe it doesn't hit that number. Maybe it doesn't need to hit it. Maybe we do consider recapitalizing them a little bit and giving them some cash so they can go after some, because oftentimes, they're in a scenario when it's a recap that they've been trying to work with the current lender for 5 months and oftentimes coming out of pocket with a significant amount of equity to keep the deal afloat and keep their subs on the job and keep everything moving. So we'll look at that deal and give them some cash back. If it's warranted, we feel we're in a good enough position, we'll go up high enough to give them some money back. So we feel very strongly about, executing on that. And, like Paul was saying, it's a bit of a Rubik's Cube type of thing. Once you figure out what's been done and what needs to be done, you move forward, and we'll get, and oftentimes these assets pre-COVID, were things that frankly banks were looking at primarily, or other CMBS shops or things like that we're looking at that were taking these assets down and working with them, but that they're looking for certainty of execution mainly. And so that when you talked about like 3 things as a broker, like you were looking for, like, what's the pricing, certainty of execution, and I think leverage, right? What nobody really cares about pricing anymore. Everybody's thinking, can you get my deal done? Will you be able to execute? And, and one thing we do is, before we ever put a term sheet out here, our CEO signs the term sheet, and that means that if the deal is remotely close to what they've advertised, we're closing on those terms. It's still got to get appraised. There has to be a construction risk assessment. Things like that need to get done. But we have the capital, and we want to put it to work and help the economy move forward to the point of getting a benefit out of the labor side of things. Right. So that deal we closed in March, the sponsor wisely went back to the market and got a reduction in his overall cost by like $2 million, to do the deal. And that's because of the fact that hotel jobs had stopped and other things, and there were just people that needed to work and get going. So it's very builder friendly, I would say, as far as that goes. And
absolutely.
As far as the ground up side, straight up ground up deal, we'll work with PACE, by the way, on the recap and get to 80, 82%. Same thing on the ground up deals. We'll get to 82% leverage. Without PACE, we'll get to 75.
Awesome. Thank you.
Yeah, no problem.
Doug, go ahead. Your audio, I missed, your audio just popped out for a second.
Sorry about that. To Dominic, pick up where Dominic left off. Talked about in his business not a lot of price sensitivity. As a ground up construction lender, now that I'm getting better sponsors, better projects, I'm finding just the opposite. I'm finding price resistance finally, as we're about 250 basis points over where we were in early 2019, 2018. So it's been more of there was sticker shock. There was a disconnect between the bid and the ask. I have LOIs out, but a lot of the top shelf sponsors are still real reluctant to take my price of capital, at all in, annualized of maybe 10%, 10.5%.
I've definitely seen that as well. It's a good point to bring up. I mean, when you just are coming off a cycle where you were getting bank rates in the 3s, okay, and then you were getting mezz or pref that would blend to maybe high 4s or 5s, and now it's like, all right, your blended rate is in the 8s, right? I mean, so I've definitely seen quite a few people, even if I do come in with pace and blend it down, you're still talking about 7s, probably 8s. So there's definitely a lot of people that are just like, we're just going to hold off and wait and see. And I do think it's those more institutional groups that are just like, we're not doing this because our structure is more of, we have a big LP partner, they're putting in all the equity, all we need is 60% leverage. We're just going to wait till we have a bank come back. But frankly, there's a lot of groups that they just can't wait. And so I see that there are a number of ones that are non-institutional developers. They're probably more in the middle markets. And they're like, you know what? We still have some good profitability. We believe in this, and we'd like to keep more of that upside. We want the leverage. We need it to be non-recourse, and they just accept that they're going to have to pay up. But it's definitely a decision that's being made, to your point, that it's a big difference in pricing. I think the biggest thing, and I think we should jump into this now, it's all about the execution at the end of the day. As much as every borrower and every advisor wants to ask about the lowest pricing you could do and the best leverage, and everybody knows it's execution at the end of the day that is the most important. That's kind of glossed over, and it's somehow almost accepted that everybody comes through with what they say, right? Although we all know that doesn't always happen. So let's talk a little bit about certainty of execution. I think we could talk to what's your source of capital? How are you set up? We've heard a lot about folks that were relying on CLO execution. They needed to sell off a lot of their paper. They got really in a tough spot. Tell me a little bit about how your capital is set up, maybe like the highlight in terms of discretionary level, maybe decision making. But I think that'd be really important for folks to understand, how you're capitalized. And Daniela, why don't we start with you and Castellan?
Yeah, sure. I think this is probably one of our strongest suits at Castellan, actually, is our certainty of execution. As I mentioned, we are discretionary capital balance sheet lenders. So, we have a fund that's made up of probably 250 high net worth individuals. Our investors do not have approval over each deal. That lies basically at our committee level, which is myself, Paul and John Salib, who are the two principals, brothers that own the firm, and another gentleman, Eitan Slomovic. So once you get a term sheet from us, it's already been approved by credit. There's no third-party credit approval. There's no outside investment committee. We've closed well over 500 deals, and we've never once changed the terms from a term sheet. So I think that's very important. And as far as capital, we have all of our own capital. So we're not waiting to syndicate a loan, or we're not waiting for funds to come from another third party. One of my favorite stories is we actually had a quick close multifamily acquisition deal that came to us. It was in Florida. It was an $18 million deal. It was not a typical bridge borrower. He was very used to CMBS, bank debt. His lender fell out, and he had 5 days to close on this 1031 acquisition. So we give him a term sheet, trying to get him comfortable with the idea of taking a bridge loan. And he was like, yeah, but how do I know that you guys are going to close? How do I know that you're going to be there? And so we showed him, a bank statement showing our liquidity and our funds. And we said, does that get you comfortable? And he said, yeah, a little bit, but not quite. And so what we actually did is we worked with a title and escrow, where we wired the full loan amount into escrow prior to close. And we said, as long as you're willing to pay interest, for the 5 days on this $18 million, that's how we'll be there. And that got him more comfortable. So I think just having that flexibility, having that capital, and being able to make that decision all in one day is really what matters to borrowers a lot right now.
I agree. So that's interesting. So you were able to fund the entire amount, show, hey, the money's just sitting there. Yeah, you might have to pay some interest on it, but it's there. There's no denying that. And that got them comfortable.
Exactly.
Got it. Let me ask you just one follow-up question. What kind of capital are you looking at today? How much has been raised that's available to be deployed, kind of roughly speaking?
Yeah, as I mentioned before, capital is definitely not an issue for us. We have the capital, ready to put out. I think, prior to COVID, we were hoping to put out about 350 million this year. I think now definitely we're not setting a target for ourselves as far as we need to put at X amount this year. It's more of just looking for quality deal flow. So as long as we have the quality deals, the capital's there. And like I said, we're actually focusing more on lower risk, lower pricing deals, and that's our focus moving forward this year.
Awesome, thank you, very helpful. Doug, a little bit about how Parkview's set up. I know it was yourself. I think it's Paul as well as the CEO. Tell me a little bit about how Parkview's set up in terms of capital structure, discretion, how you fund. Let's talk about how you execute. Would love to hear a little bit more about it.
Sure. Well, execution is very important. Obviously, Danielle's in a great spot. Congratulations. That's a real awesome place to be. Certainty of execution, moving fast. There's a huge market for that. I've been in that position before. It's a wonderful position. There's just nothing better than having discretionary use of that much capital. So kudos to you and your group. That's awesome. Adam, one of the things that is I'm seeing a lot more in the market now than I have since the 2008 meltdown is retrading, lenders retrading deals. It's frustrating for everybody. It's prevalent now. A lot of it is the people that used to be direct lenders or quasi-direct lenders are frozen now. And so they're requoting deals, they're retrading deals as a opportunity to get more time till they can actually find the capital to do the deal. So that's very frustrating. We don't do that. We do our best to not do that unless something has significantly changed in underwriting or along the process. Then we won't retrade rate and fee, but we might adjust the loan proceeds. We are a mortgage REIT. Capital is not a problem for us. We're a low leverage mortgage REIT. Our plan this year was to do 600 million. We're only maybe at 150 million now. Where are we at? Headed into Q3, right? So we have plenty of capital. It's not certainty of execution. It's now we are slow to execute because of the uncertainty in the marketplace and because of the virus and what's going on. So it's for us, we used to be very capable of closing a ground up construction deal inside of 60 days. Now we're slow. We're looking at deals more carefully. We're looking at more deals. So it's not certainty of execution for us. It's timing. 2 months ago, we were quoting 90 days. Now we're back quoting 60 to 75 days to close a deal. One thing that helps us execute on ground up construction deals is we have an in-house team of 3 construction experts, a construction engineer, construction management group. So we literally get in, take plans, specs, do takeoffs, research the cost, research the numbers in the submarket. So to that end, we have great certainty of execution. And to that end, we reconcile all of the budgets, all the costs, all the pro formas based on our own internal research. And once we come to an agreement and make the deal, there's a high certainty of execution because both parties, developer and lender, have really tried, true, and perfected the numbers.
Got it. We'll talk more. I'm going to go back to that. Yeah, that definitely is interesting here. We'll get a little more into the process. Domenico, tell me a little bit about how UC is set up, where are you funded from, and a little bit of the process.
Yeah, it's private discretionary capital. In fundamentally, as far as our process goes, it really goes. The term sheet that goes out from us is scrubbed really well before it's ever issued. So, the idea is to do all the brain damage on the front end. So on the back end, you know what I mean? That there's no problems. Now we don't do an appraisal or anything, right? But it's until the sponsor signs up. But we pretty much know what the deal is by the time the term sheet's issued. And we've got enough experience. We use CoStar all the time. You know what I mean? To discern what's happening at this asset. What's going on, and just use whatever we have at our fingertips on the front end to make sure that we're there. Adam, you can attest to the amount of machinations on a cap stack that we go back and forth on, especially when we're looking at pace, right? To kind of fine tune it. So as far as execution goes, I always just point to what we've done, right? Everybody I talk about this being our 10-year anniversary, and we've done $2 billion in those 10 years, and we're blessed to be able to do it. But I always say nobody really cares, and they don't. Nobody cares what I did in the past 10 years. They want to know what I did in the past 4 months. You know what I mean? When I'm talking to a bar, and we are not having we have a very bullish approach to the market. Okay, and not reckless in that it's very thoughtful because we look at a deal by deal basis. But we feel, as far as we deal in the world of leverages and pricing, right? So we're bullish on the fact that, we don't believe that America and the economy is going to tank that much. It's a far different thing than 2010, and in that whole dynamic, we feel this is a hiccup in that it's going to come back, and even stronger. So we really look at this as a real opportunity for us to provide, when I'm on the phone with people every day, it is amazing the hopelessness sometimes, that I'm hearing from sponsors and stuff like that. And when we start talking about it as lenders, when we start talking about, hey, we closed 3 deals last week, right, in Birmingham, Alabama. We closed the deal in Mesa. We closed the deal here. People understand that people are transacting, and Danielle and Doug, that's what the market really wants to know is what are we doing as lenders, right? What's happening, and that's the certainty of execution. And that when we can talk about the deals we've closed in this period of time, which we're fortunate enough to have closed a lot, that right there, just like I said, nobody cares about pricing anymore. They just want to know, can you close the deal and get it done? And and the good news is, we've been able to withstand now from one down cycle to another and came out of it, and we know what it looks like as we all do sitting at this table. But, that's the name of the game, and we're fortunate to be able to provide it to the market.
No, I just have to back on that. I think you had a great point. I mean, this was a healthcare crisis. This is a healthcare crisis that has stemmed into an economic crisis. I mean, so everything, all the fundamentals of the economy we were on solid footing 3 months ago. We're still expecting to grow a bit, a slower growth in 2020. There was still most economists were still forecasting growth. There was the talk of the shallow descent, and the big news of the day was Boeing and Brexit. Now you don't even hear about those things anymore. They apparently are gone. But, at the end of the day, just to reinforce that point, the economy was doing really well. And we should be able to turn this around rather quickly as a result. And the fact that most financial institutions were on solid footing as well. I mean, this was not no one was overextended. We weren't seeing like the 2008 housing bubble that even Stevie Wonder could have saw coming. I mean, this was something that we were all in, good shape before. And also just to kind of reinforce some of, as far as the data and what CoStar is able to provide in terms of the underwriting reports, particularly in multifamily, since we've acquired apartments.com, now you're able to look at your comps a little bit differently, not just the typical, like the number of units, the proximity, rent. You could actually examine or just determine by what other apartments people are searching for. It's kind of Big Brotherish a little bit, but it gives you a completely different way to look at your comp set. And I use it all the time. It's one of the coolest things in the CoStar suite of services. I don't know if anyone else had a chance to use it, but we've added in terms of we have a complete underwriting report available. And also within each market, we now provide a capital markets report for each asset type as well. So this is definitely a time we're all busy. We're trying to find new ways to get data out, and really more folks are requesting, this information as they are making data-driven decisions during this time of uncertainty.
Let's stay on that point for a second, because I think a lot of folks have been wanting to see what are the June numbers for collections, what's happening in different apartment sectors from A, B, and C. Paul, do you have any real-time data on like how June looked like how we were doing. I think everybody kind of wanted to see, now that the stimulus is kind of worn off, everyone got their checks back in April. Are people still paying? Are there certain asset types that are better than others? Let's focus on multifamily in terms of vintage.
Yeah, I mean, we'll first starting off. The people have been paying their rent. Long story short, and I think a lot of that has to do with the unemployment benefits and everything else. The federal government and Congress has basically thrown out all the stops to help the U.S. economy through this, and it has paid dividends. We have shored up a lot of the bleeding, you want to say, or the heartache that we would have potentially seen. So we haven't seen any major drops in vacancy rates. And we also have we also track daily asking rent as well. And why we peaked right around the beginning of March is when we saw we hit about $1.52 per square foot. And then it started to slide a little bit heading into the end of May or end of April, just by about a few cents rather. It wasn't dramatic, but now we're seeing that tick back up again. So we could see, and this goes across all markets, particularly, Philadelphia, Boston, and some of the Northeast, they've really, almost a spike back in the asking rents, and the amount of concessions have declined quite a bit as well. So the market is stable across, just generally speaking. Now, in terms of asset types,
let me just stick with that for 1 second.
Yeah.
Paul? One thing just on that point, because I see that most developers, most property owners, they don't want to lower their rent, so they add concessions. And so I've seen that's a trend that you got to pay attention to. It's tough to get that data. I've certainly seen a creep up in some markets where folks that maybe were at 2 months have now creeped to 3 months for new product to move it. They haven't lowered their rents, but they've said, hey, we're going to give you a little bit more. Do you guys track that? I know it's tougher to get access to it, but do you have any data on how concessions are in different markets?
Yeah, we do track concessions, and it appears that some of the higher end, particularly in downtown locations, are offering the highest level of concessions right now. Just due to the fact I think they're having trouble filling some of those spaces. But I believe that's just a short term. I think people are kind of, like I said, there's a little uncertainty right there, and folks are maybe not willing to make that jump. But we did see that spike a few months ago, but now we're seeing it level off and actually decline in most markets. And also, we have to remember that this is a very local. Every market has a different story right now, particularly as how they've done mitigating the pandemic in the beginning and how we're dealing with it now. Like if you look at the experience of Dallas or Texas, we were ahead of the curve for all intents and purposes. We thought we were out of the water. We thought we were happy days. We're done. And then, Memorial Day and 4th of July rolls around, and we're beating records for the number of cases every week. I mean, so it is very localized. But I see a lot of those concessions have stabilized overall, and the rents and vacancies have remained stable as well. We haven't seen any spikes in any major markets yet, and I think that's a testament to the underlying strength of the economy.
Absolutely.
In terms of the asset types, we were worried about some of the Class C or those 3-star and below, because so many of those renters typically have those service industry jobs or the restaurant employment, the hospitality employment. We thought they would be some of the first to kind of, we're bearing this brunt of this, but a lot of landlords have really made been able to work with their renters, and we have not seen a spike in vacancies yet. And even in our 4 and 5-star or Class A properties, we're seeing some increased activity, particularly in our search activity through apartments.com. We're able to track this. As let's say you have a roommate in a nice downtown apartment, you realize that you don't want to spend all day with this person. You're looking to move out and get your own place, or even, so we're seeing a lot of that as well. And the solid markets that were on solid footing with good economic underpinnings are still doing well. The ones that were maybe, you could say they were, were having some difficulty before, that's putting a spotlight on it. But, I'm still bullish on, even the New Yorks, the LAs, the gateway markets, even the high flying Southern markets, we're doing quite well. I mean, we have not seen the bottom fall out yet. I'm surprised how resilient, particularly multifamily's been. Industrial, just to kind of highlight that, has been going off. We're seeing record leasing. E-commerce pretty much every day we're seeing new spec buildings being announced. And that seems to be almost immune to this pandemic, if not thriving as a result. Retail is just another story. We can talk about that maybe in greater detail, but that's kind of what we're seeing in terms of the rents, concessions, and our average rents. And even back to the point of LA and the net absorption thing, I didn't want to make it appear that the sky was falling with LA. We're talking a negative net absorption of a few thousand units in a market with nearly 200,000 units. So,
perspective, right?
Yeah. So it's very small. I think it is. I think it was a blip. I think it's a blip. I mean, quite frankly.
That's the economist in you.
Yeah, exactly.
I'd like to do this. We are, guys, we're in July, and we just went through the first half of the year. It's wild that we're already in the second half. Let's talk about what the rest of the year looks like. I think you're hearing some interesting ideas, insights. It seems like last quarter that we just came out of in second quarter, there was a lot of trying to figure it out early on in April. Some people moved quickly towards one direction. Some people wanted to kind of assess. Let's talk a little bit about, in each of your groups, what do you see for the rest of the year? What are some goals? Who do you feel that you could best help right now over these next 6 months? I feel like we're all solving people's problems. So tell us a little bit, like, who's a really good person that you could help out right now? What's that situation? And let's get a little bit more into where you think you could really, make a difference. Why don't we start with Daniela?
Yeah, sure. And before getting into that too, I want to just kind of piggyback a little bit of something that Paul said. I think that he did give great insight on collections from the landlord perspective. But to go even further from the lender perspective, I'm happy to say that for us, for June collections, we're at 100%. So we haven't really seen that wave of defaults that, everybody was kind of expecting in March, April. And I think that also goes back a little bit to what Doug was saying earlier about warning against over leveraging, because I think that what we found is when you do invest in quality projects where the sponsors have a good amount of equity, whether that's cash equity or even imputed equity ahead of you, they're willing to keep these properties afloat during this kind of period of uncertainty. So I think moving forward, we're continuing to look for the same type of properties, maxing out at the 65%, strong sponsors. We do lend to foreign nationals. We don't run a credit score, so it's not necessarily that they need to have strong liquidity, but I think experience, something that we're looking for in our borrowers. Still a lot of quick close transactions. We're pretty flexible, I think, with our fees. We do have no prepay, no minimum interest. We also have become flexible as far as our origination fees, where if a borrower thinks that they can pay us off in 3 months, 6 months, we'll kind of break up that fee over the course of the first year. So it's almost like an incentive to take us out sooner. So moving forward, I think it's a lot of the same stuff. Quick close acquisition, construction completion loans. I'm seeing a lot of situations where banks are putting borrowers in defaults, not only maturity and payment defaults, but technical defaults, specifically related to construction. Maybe they're not reaching construction milestones. There's an equity rebalance, things like that. So I think we're going to continue to see a lot more of those projects in the next 3 to 6 months. And we're happy to do those, definitely.
Yeah.
So I think just as important as knowing what you want to see more of, a lot of folks are just, they want to know, what do you think you just don't want to It's good because you see an overwhelming amount of deal flow. What's just not a fit? Maybe you could just kind of go through some high level, what's just not a fit for the group in this environment.
Sure. So, we are not doing hospitality, but that was actually a decision for us pre-COVID, just because, like I mentioned, we did do 4 or 5 hospitality deals last year, and just portfolio exposure, we're not looking to do more of it. We're not really big on land, and we definitely don't do ground up construction. So those are kind of our areas where we stay away from. But,
Okay.
Other asset types we're open to.
Okay. And you did mention condo inventory financing is something that you're looking at in certain markets.
Yeah. I think definitely, of course, California, New York, Florida, Texas. That's kind of where we've seen the majority of that deal flow.
Sure.
I think that now we're open also to other markets too. Colorado, we've seen some Oregon, Seattle. We would do that as well.
Awesome. Thank you. Doug, a little bit, what do you like right now? What do you think the group is going to do great with? And what do you think is just not going to be a fit so that people don't have to waste the time?
Yeah, sure. Bank fallouts. Deals that in the last 90 days have been in the bank pipeline, and the bank just called a timeout and said, not for us right now, and we don't know when it'll be for us. Deals in technical default, like Danielle mentioned, perfect for us. We'll come in and help solve those problems, take the place of the existing lender, move forward. Construction completion, of course. An asset class I think we're going to stay away from for quite a while is student housing. There's the uncertainty that the virus and what's going on in the educational system when we're getting back to school is just probably for us a non-starter right now. And we did a PACE deal up in Texas in a student housing project. So that's probably a class that we'll stay away from. Hospitality's never been for us. I think for all of us, if we get a vaccine, if we get closer to the election or past the election, I think those are a couple of things. We see what this shadow distress is going to look like. And what I mean by shadow distress is, all the payments are current now, rents are current now, the banks are pretty healthy now. What is it? What don't we know that 6 months down the road? When there's past forbearance, when the federal backstop is gone, none of us have any idea what that might look like. And so once we get a little better feeling for those 3 things, I think it'll be a lot more lending as usual.
Got it. Thank you. Dom.
Yeah, we'll look at all asset classes. We've actually closed the land deal during this past 4 months.
Get out of here. Come on.
Actually, there's 2. It's ridiculous. There were 2 land deals. So, and so it's one of those things where, it's right? How much cash they got in the deal? What's that looking like, right? And their experience, obviously, Danielle's to your point, they got to know what they're doing, and locationally, Doug, these cities that we're talking about and lending in, that Paul's talked about, these gateway cities. There's the amazing thing is a lot of these deals are coming in those gateway cities that we're seeing, that we typically wouldn't have maybe seen last year, or probably wouldn't have.
Sure.
And so we're open for business and we're closing, and I think we just feel very bullish about this period of time in real estate, and we feel it's really an opportunity for us as a lender to provide capital to a market that desperately needs it. And we also feel that the bets, if you will, that we're making on the assets and the leverage are very solid. We don't see, LA tanking, Hoover, Alabama tanking, Birmingham tanking, Norfolk tanking anytime soon, and all those things there's just so much economic drivers going right now. We feel very strong about that. This is a perfect time for us as a company to just really provide, again, that certainty of execution to the market. And we're going full steam ahead with it.
Awesome. Let's go with Paul, and then I'm going to share, and I'd like for everybody to give us some thought. I'm going to feed this there. What's a big idea that you think people could take advantage of over the next 6 months? I'll leave you with that. But Paul, let's kind of go to you for a second. what do you see with data trends over the next 3 to 6 months? I think to Doug's point, we're kind of a little bit in a wait and see mode. We have some blind spots that we just don't know what we don't know. We're going to have to see how things fall out over the next 6 to 9 months. But what are some interesting data points that you're seeing right now that you kind of think we should be paying attention to?
Well, I'd say one of the key data points I've been following, and we're always looking for real-time data, is that daily asking rents. And we have those for all of our asset classes. And that's the one where we basically have been indexing those, and we're surprised how high, how quickly the asking rents have rebounded pretty much across the country. That's one area that I'm focused on. Another is really just, the unemployment or the employment numbers. That's really going to be the driver of a lot of this. We've shed there's no question about it. The economy felt some serious pain in the first half of the year as a result of this, but we are seeing employment start to move in the right direction. We are seeing, some movement in terms of the employment employment. And I predict, and we rely on Oxford Economics for a lot of our forecasts, but I see us almost to pre-pandemic employment levels by middle of next year, possibly the end of this year. I still believe that V-shaped recovery is going to occur. In spite of everything going on, we still have solid economic underpinnings beneath us, and hopefully, this does turn around quickly. Another, just in terms of, if I wanted to look at another kind of outside of multifamily, I'm looking at the office sublease space. I think that is oftentimes a leading indicator. Our offices shedding space, and we are starting to see a little of that in some of the energy dependent areas like the Oklahoma cities or even the Midland Odessas as a result of the low oil prices. Unfortunately, they're also an industry we haven't had a chance to talk about today, but they've really, they are feeling a lot of pain as a result. Another kind of just indicator that I love to look at in real time is Google searches for bankruptcies. This is something that I know it's not the most, glamorous thing, but you can go on Google Trends. And if you follow it going back to 2000, right through the economic upheaval of 2008, it would almost go in lockstep as far as the number of initial employment claims and searches for bankruptcy. This, what makes this unique is we've seen the initial unemployment claims pretty much skyrocket, where the searches for bankruptcies have remained relatively stable. We have not seen a spike in it. So that's one that I'm keeping my eyes on as kind of an oddball one. But to that again, I think that speaks volumes of those underpinnings I was talking about before. And also air travel. I think that's going to be a leading indicator. Are people getting on planes again? Are we burning gas in planes? And also the price of oil and the price of gas are two that I'm looking at.
Got it.
What is the price of oil, Paul, today?
About $43 a barrel.
That's not bad. I mean, it was at 20, right?
It was negative.
Oh. Come on, coming back.
It is, and it has. And a lot of that is, it's the global. If we are integrated in the global economy, the Eurozone has turned the corner. China is now ramping up their factories. So if that is a message of things to come to the U.S. in the near future, it proves that we all are probably sick of working from home, and that there is a sense of depression or whatever you want to call it. The fact of the matter is that other countries have gotten out of this, and we will get out of this as well.
I'm optimistic as well. I don't think anybody thinks this is a long-term 5+ years. I think we're kind of looking at a couple years, in some cases more than not. But I think everybody is just really looking for that, that breakthrough on the health being able to see a vaccine or some kind of more effective treatment. So until that day, hopefully sooner than later. So let's just kind of end with big idea. I'm going to share one on my end and my niche. I am getting inundated with requests for people to get recapitalized, and they're looking at PACE to be able to help them as much as possible. So I'll give you a scenario that's pretty typical, and I want to hear from you all some things that you're seeing. But let's say somebody built a hotel, they completed it in December, $50 million to build it, maybe they have $25 million of debt on it. The hotel has not been open for the last 2 months. There's no money to pay for operations. There's no money to pay for interest. What do? Right? So maybe a lender is given a 90 to 120 day forbearance, but now is around the time that folks are saying, what do we do? So I'm getting requests to use PACE financing. Let's say in a case like that, maybe you could get up to $10 million. The request is to take as much as we can and apply $2, $3, $4 million to an operating reserve and an interest reserve for, let's call it a 2-year period until the asset starts to recover, starts to open back up. This is any asset type, but let's just use the hotel because that's where I think you need it most. And then out of anything remaining, swap out some of the dollars that the lender has. So let's say you take a $25 million existing loan down to maybe 22 to 20 million. And so I'm curious where you'll start to see that more and more, but we're certainly seeing a ton of those requests. Dom, I know we're looking at a scenario mid-construction that, some version of that. It's a retroactive use. I think for Daniela and then Doug, you'll see more of those where it's going to be post-construction. And so whether it be construction completion, Doug, I think that works for you. Daniela, I think it'll be after completion of construction to pay attention to. But we're certainly seeing that as a real creative way to work out. And it really just come down to either the existing lender will say, this makes sense for us as a way to keep the loan performing, or there might be a new group that says, we like this basis, we're good with it. But I think that's a real big idea to leave people with, that there's going to be some creative workout solutions. PACE should definitely be on the list. And I think it'll be a case-by-case basis. You can't have a bad deal get better with PACE, but you can have a good deal become better with it. I'll borrow that from the opportunity zone world. And so I think it'll be good to keep that in mind as a strategy, as a big idea that some folks will have some luck with. Danielle, what about you? What's a big idea that you're seeing that maybe people should pay attention to in terms of getting them, out of some challenging situations that we're working with? Any kind of niche area where there be, this retail deal you just closed, maybe some people didn't realize that was possible, but maybe you could highlight where you're seeing some insight into helping people out.
Yeah. So I think for us, our underwriting usually comes down to basis. In the bridge space, we're used to not seeing the cash flow. Most of our properties typically don't debt service coverage. So I think, for landlords working out kind of rent abatements with their tenants, things like that, and funding, just like you said, interest reserve and operating reserve, we would definitely look at deals like that. I think specifically related to the hospitality side, something that we've seen, and I would recommend to any developers listening, is if they have, vacant hospitality buildings, speaking to their local city councils, because I know that a lot of cities right now are leasing those up specifically for COVID patients, affordable housing, things like that. So I think that that's just definitely another opportunity.
Absolutely. It's a good idea. Doug, yourself.
You're not going to like this. My big idea is solve these problems with equity, not debt. Instead of adding another layer of CPACE or another layer of debt onto an already, a project that's already having challenges, I think might be exacerbating the challenges. So if you have the possibility, or if the possibility is there, solve current problems with equity, not debt.
Got it. Any sources of equity that's not going to take too much of the deal and the rate? I mean, who are you seeing out there that would be able to step in as equity that's not looking for just crazy economics? Anybody that you're aware of in terms of a profile? Yeah.
No, not really, Adam. When I say that, I just mean typically internal equity, friends and family, partnership equity, the guys that are already in the investment that want to hold on to the investment and still believe in the investment. Going outside for equity right now at this time is probably futile.
I agree. Domenico, my friend, what do you see happening? What big idea do you see right now available for people?
So a couple, right? One is don't watch the news. Okay. All right. That's the worst thing you can do right now. Okay. Is watch the news, because that will drain you. It'll suck your blood. It'll absolutely, you'll feel like, so that's the mantra in my office, my charge to my team and throughout the company, watch the news. Okay. Okay. The other thing is work out, right? That'll help decrease your stress and you'll feel better, right? Thirdly, I think pace is a good solution on those recaps, and not to counter you, Doug, on that, but just having experienced it on a couple deals. Usually these deals, because it's not an economic crisis, it's a health crisis. These deals aren't going to lose the economic value, And so what we're seeing is, because lenders have stopped lending on certain deals, that the pace coming in as a backstop to fill some kind of gap and offset the stress on the deal, actually still, even on appraised values with a COVID hit on the appraisal, usually the appraisals now are coming about 10% short or so, from where they were a year ago. That still is a really good option. So I think in general, as far as what we do on a daily basis to the market, I think it's just important, to Dallas' point, to know what the basis is, know what the exit LTV is going to look like, and really, don't sit on the sidelines. Go after these deals, because there's real value out there. I think there's more value now than there was a year ago or 4 months ago. There's more value deals out there, and the people we've been closing with have been getting that value.
Awesome. Thank you. Paul, any interesting insights? Anything else that you good?
I would just say, don't count out retail. I mean, it truly is the Lazarus of asset classes. Everyone has been down on retail for the last decade, and e-commerce was going to kill it. When I look at the vacancy rates in retail, they're still at 5%. There's still anchor stores. Look at parking lots, they're still full. Consumer confidence is starting to increase. And just looking at like the sales volume of retail. In 2019, there was $67 billion in retail sales, in sales volume in terms of transactions. Then it was pretty much steady all the way through 2015, 2017, 2019. It's fallen off a little bit in 2020, like most asset classes, but I think retail is one of the most dynamic asset types, and it's undergoing the most, you want to say revolution or evolution. I would say
evolution. It's an evolution for sure. Yeah, I agree. It's just evolving. Go ahead, Doug.
This is not a big picture item, but something for the audience to consider. I know, there's probably a bunch of brokers in the audience. We've all probably been brokers or brokered at one time or another. But now I think brokers transition from connecting capital to borrower to more of an advisory role, because things have changed so much. Now we're talking about sophisticated capital stacks, more than ever before. We're talking about debt, equity, EB5, CPACE. And so my guess is a lot of sponsors don't know of all of that capital available to them. So if you're a broker that typically literally just introduces, capital to a borrower, now go into an advisory role. Might be a way to make some money, make some more deals, build your credibility, build your expertise in our business. Because I think now an advisory role is very valuable to sponsors.
I love that, and I'll add one thing to that. I think niches. I actually just talked about this. I do a lot of messaging online, especially in this niche area of CPACE. A lot of people don't know about it, so I do a lot of outreach. But I find that advisory, being an expert, being somebody that could provide real niche knowledge, people don't want to just be sold. They want to learn about things, and they want you to be somebody that they could come to for expertise. I like that in general. I think a lot of folks are looking for expertise right now, and to be that expert in a niche area is more critical than ever. People are looking for solutions. So I found that helpful. I'm certainly in a niche area. that I love. I brand myself the CPACE guy, and so a lot of people have me as their go-to for CPACE. But I think that's important, to be that trusted advisor. It's always been important. Nobody wants to just be an order taker. I think you really want to be somebody that could be, a guide. Really help somebody get to where they need to and help them, get to that solution. So I think that's really important. We're just kind of wrapping up. Thank you guys, so much for being with us. This was almost 2 hours that we've been going at it, and we're just wrapping up. Any last words that you want to say, Daniela? Anything to leave people with regards to you, program? Maybe anything else that you want to share that you haven't already covered?
Yeah, I guess just the general message is that Castellan's open for business. We have money that we're ready to put out, and we'd love to work with borrowers to kind of structure exactly what they need to make their deals work, both on proceeds level and timing.
Sounds good to me. Awesome. Doug, yourself?
Of all the things we've talked about, I appreciate Dominic's comment on turning the news off. You want to talk about just negative energy and a waste of time. We all want to stay up. We all want to be smart. We all want to learn some stuff. But you want to talk about a drain and something that'll lower your vibration, lower your energy level, and reduce your positivity every single minute of the day. It's the news. And so, Dominic, nice call, brother, right there.
I agree.
I like
100%.
Yeah.
That's God's grace, Doug, let me tell you. That's it. I would say that, Adam, the thing we want to do, we want to close $1 billion this year. This year, as my CEO said, this is our Super Bowl, is how we look at it. And, we're fortunate, all of us sitting at this table, to be doing what we do in commercial real estate. It's solid job. It's good living. You know what I mean? We're so blessed to be able to do what we do, all of us here. And I think, so I wish everybody here luck, in the upcoming months. That's our goal here at UC Funds. We'd love to help, you to help us do that, put that money out there.
Love to help you do that, all you guys. All right, awesome. Thank you. Paul, yourself, any last words?
Well, I'm just one more fun retail fact. The average asking price per square foot in 2010 was about $1.33. In 2019, it was over 212. So, that would have been a great investment.
Yeah.
Again, CoStar is still open for business. We're still adding new properties. We're making those calls, and we do truly serve as that even-handed broker of information. I know lots of people from maybe are customers of ours, and we always we love research, and we're always glad to help out. So thank you again. This has been a lot of fun, Adam. I was worried about the 2-hour thing as well.
I know. I said we got this. There's no issue. I want to just end with a message of positivity and optimism as well. I talk a lot about that. I think the mindset is so important to be conscious of. It's easy to listen to the noise, the news, a lot of people that are doom and gloom. And it's unbelievable. I've seen this time and again, and everybody here on the panel, we've been through life, and we know that there's incredible opportunity and challenge. And you have to remember that. You have to be resilient. You have to have grit and perseverance. And I think that these are the times when there's challenges that you get creative. It's unbelievable what happens in these challenging times. So I'm excited for the future. I think we have, obviously some road ahead, but there's incredible opportunities that are going to get created out of this. We're going to look back at this time, and we're going to say it's unbelievable, the innovation that's happened, and it'll continue to happen. So I'm excited. We're open for business. Hope to do more business with everybody on the panel. And thank you all so much for tuning in. Thank you, all the panelists, for being so great on this. Thank you.
Thanks, everybody.
Thank you.
Thank you.
Bye.
Take
Good
care.
job, Adam.
Great job. Thank you.
Yeah, great.